Ever wondered what debt is and how it works? Well, let's dive into it. Imagine you're buying a house, a car, or perhaps furthering your education. These are large purchases that you might not be able to afford outright. This is where debt comes into play. Debt, in its simplest form, is an amount of money borrowed by one party from another. It's a financial tool used by many corporations and individuals to make these large purchases that they could not afford under normal circumstances. Think of it like this. Debt is essentially a promise. You're making a promise to the lender that you will pay back the amount borrowed in full and typically with a little extra. This extra is what we call interest, which we'll talk about a bit later on. So essentially, debt is a promise to pay back the amount borrowed plus any agreed upon interest. Debt comes in many shapes and sizes. Let's break down the most common types. Firstly, credit card debt. This is probably the most familiar type of debt for many people. It's a form of revolving debt, which means you have a limit on how much you can borrow, and as you pay off your balance, you can borrow up to that limit again. The interest rates on credit cards tend to be higher than other types of debt, which can make them tricky to manage if you're not careful. Next, we have mortgages. This type of debt is used to buy property. It's a long-term commitment, usually lasting between 15 to 30 years. The good news? Mortgage interest rates are typically lower than other types of debt, and the interest you pay is often tax deductible. Then there are student loans. These are used to cover the costs of education, including tuition, room and board, books, and other related expenses. They can come from the government or private lenders, and the repayment terms and interest rates vary significantly depending on the source and type of loan. Personal loans, on the other hand, are a bit of a wild card. They can be used for just about anything, from consolidating other debts to paying for a wedding or a vacation. They're typically unsecured, meaning they don't require collateral, but this also means they often come with higher interest rates than secured forms of debt. Finally, auto loans are specifically for purchasing vehicles. These loans are usually secured by the vehicle itself, which means if you default on the loan, the lender can take the vehicle back. Each type of debt functions differently, with its own set of repayment terms, conditions, and interest rates. Some forms of debt can be useful tools when managed responsibly, allowing you to make big purchases, invest in your future, or cover unexpected costs. However, other types can be more burdensome and risky if not managed carefully. Understanding the type of debt you hold is crucial to managing your finances effectively. Interest rates are a key part of any debt, but what are they exactly? Interest rates, in a nutshell, are the cost of borrowing money. When you take out a loan, whether it's for a car, a home, or education, you're not just responsible for paying back the amount you borrowed. You also have to pay an extra percentage of that amount over time, and that's what we call interest. It's how lenders make a profit from the service they provide. Now you might be wondering, how does that affect the total amount to be repaid? Let's imagine you take out a loan of $10,000 with an interest rate of 5% per annum. Over the course of a year, you'd have to repay not just the $10,000 but also an extra $500 in interest. Different types of debt come with different interest rates. Credit card debt, for example, typically has a higher interest rate than a mortgage or a student loan. That's because credit card debt is considered riskier for the lender. It's unsecured, meaning there's no collateral like a house or a car backing it up. But it's not just the type of debt that can affect the interest rate. These rates can also change over time. They're influenced by a variety of factors, from the health of the economy to the policies of the central bank. In periods of economic growth, interest rates might rise as demand for credit increases. Conversely, in times of economic downturn, rates might fall to stimulate borrowing and spending. Interest rates might seem like just another number, but they can significantly impact the cost of your debt. A higher interest rate means a higher cost of borrowing, which can translate to higher monthly payments and a longer time to pay off your debt. So, if you're considering taking on debt, whether it's a credit card, a mortgage, or a student loan, it's crucial to understand how interest rates work. They could be the difference between a manageable repayment plan and a financial burden. Interest rates can significantly impact the cost of your debt, so it's important to understand how they work. Debt can be a powerful tool when used wisely. But how do you manage it effectively? Well, the key to managing debt is as simple as ABC. Firstly, A stands for assess. Take a good hard look at your finances. What's coming in and what's going out? Create a budget that accounts for all your income and expenses. This will help you understand where your money is going and where you might be able to cut back. Next, B stands for be on time. Make your payments on time, every time. Late payments can lead to increased interest rates, late fees, and a negative impact on your credit score. Lastly, C is for comprehend. Understand the terms of your loans. Know your interest rates, payment due dates, and penalties for late payments. With these steps, you'll be on your way to managing your debt effectively. Remember, with careful management, debt can be a useful tool for achieving your financial goals. So, we've learned a lot about debt today, haven't we? Let's sum it up. Debt, a term we often perceive with a bit of apprehension, is simply money borrowed that needs to be repaid, typically with interest. We dived into the different types of debt, didn't we? From credit cards and mortgages to student and personal loans, each has its own set of rules and implications. Then we unraveled the mystery of interest rates. Remember, they aren't just arbitrary numbers, but powerful factors that can significantly impact your debt over time. Lastly, we shared some handy tips to manage your debt effectively. Budgeting, prioritizing, and staying informed can make the journey less daunting. Debt isn't inherently bad, it's how we handle it that matters. So let's not shy away from understanding it better. Remember, understanding your debt is the first step to managing it. So keep learning and stay financially savvy. If you like this video, click the like button, comment, share with others, subscribe for more, and turn on post notifications so that you are notified when we post.